Today, we're doing something a little different. We are basically performing surgery on this very specialized analysis report.
And it argues for one of the most, well, extreme valuation disconnects I think I've ever come across, certainly in the biotech sector.
It's pretty wild. We're diving deep into a company called Reviva Pharmaceuticals.
Ticker is RVPH.
And this analysis report, it lays out an argument that is, let's just say it's genuinely hard to believe at first.
Well, yeah. I mean, look at the numbers. You have a stock that's currently trading for, what, around 28 cents?
In that neighborhood, yeah. And yet the professional analysts that cover it have price targets that range all the way up to $16 a share.
$16 from 28 cents.
Exactly. Okay, let's unpack this. Is this some kind of massive, high-risk, buy-the-dip opportunity that everyone's missing?
Or is the math just so far apart that it's fundamentally broken?
That's the question. That gap is the whole story today.
It is. This deep dive is really about understanding how a disparity this massive can even exist. Because when you see a potential 2,000% return, you know there is colossal inherent risk.
Of course.
But you're also looking at a situation where the market's perception of the company's finances seems totally disconnected from the actual value of its core asset.
So our job is to figure out what the analysis sees that the rest of the market is just missing.
Exactly.
All right. And to do that, to really get this, we have to start with the science, not the stock chart.
Absolutely.
You literally have to ignore the stock price for a minute and just focus on the product. That's the heart of the entire bullish case.
This is where we leave the messy financials and step into the world of big pharma assets. And Reviva's entire story, this whole disconnect, it centers on one single thing.
Their lead drug candidate.
Brilaroxazine. And what's so critical for you to understand here is the market it's targeting.
It's not a niche thing.
Not at all. Brilaroxazine is aimed at treating schizophrenia and other major mood disorders. I mean, this is a multi-billion-dollar segment of healthcare.
Right, a space known for blockbuster drugs and, more importantly, huge acquisitions.
Big pharma pays billions for assets in this space. 10, 15, sometimes 20 billion for a successful drug.
And that brings us to the most important detail in the entire analysis report.
The scientific milestone.
Reviva has already reported positive phase 3 data for Brilaroxazine.
And for anyone listening who doesn't follow biotech timelines, you need to understand this is the entire ballgame.
Okay, so let's define that. When we say positive phase 3 data, what does that actually mean? It's not just a concept in a lab anymore.
No, it's the ultimate de-risking event for the science. Phase 3 trials are huge, they're expensive, and they're designed to prove efficacy and safety in a large patient population.
So it works, and it's safe.
It means the drug successfully met its primary goal, the main endpoint agreed upon with the FDA. The analysis really stresses this. The drug works, and crucially, it seems to work with fewer side effects than a lot of the current treatments.
So the hardest part, scientifically speaking, proving the drug works in people. That's done.
It's essentially done. This is not a phase 1 lottery ticket. It's a late-stage asset.
And that's what's so fascinating here.
It is. The report literally describes this asset as a gold mine sitting in a bargain bin.
A bargain bin, yeah.
Because for a biotech, phase 3 success totally shifts the risk. It moves away from will the science work to can they execute financially. The biggest hurdle where, 90% of drugs fail is already in the rearview mirror.
And that successful science leads us right into this great valuation disconnect.
The whole reason the report exists.
We're shifting from the lab coat to the balance sheet, and this is where it gets strange.
Let's just lay out the numbers. At the time the report was written, the stock was around 28 cents. That gives Reviva a total market capitalization of about $32 million.
$32 million. For context, that is. That is tiny. I mean, that's less than what some tech startups raise in a small funding round.
For a company with a successful phase 3 drug, it's almost unheard of.
How does that $32 million compare to, the industry standard for a company at this stage?
It's shocking. The typical floor valuation, sort of the minimum you'd expect for a biotech that's past phase 3 in a huge area like schizophrenia, usually starts in the hundreds of millions.
Hundreds.
Yeah, 400, 600 million, and that's before you even start modeling for peak sales. The market is pricing this as if the phase 3 data just didn't happen.
Or worse, it's going to zero.
Exactly.
So that's what the market is saying, $32 million. What are the professional analysts saying?
The analysis highlights this phenomenal range. Analysts covering the stock have targets starting at a minimum of $5.
$5.
Stretching up through $10, and some even go as high as $16 per share.
That disparity is just Staggering. Okay, who are these analysts? Are we talking about reputable banks?
It's a mix, but the key point the report makes is that most targets are clustered in that $5 to $6 range. And yeah, these are institutions applying standard biotech valuation models. They're looking at potential peak sales for Brilaroxazine and getting these huge numbers.
So let's just break down the math for you listening to really hammer home that 2,000% claim.
Go for it.
If you invest at 28 cents and the stock only reaches, say, $3, which is way below the lowest target, that's already a 10-bagger, 1,000% return.
Right, but if it hits that average target, let's call it $5.60.
Your 28-cent investment turns into a 20-fold return, 2,000%. The gap is just monumental.
It is. The analysts are valuing the asset.
Yeah.
The market is pricing the cash burn.
The report puts it perfectly. It says, the market is pricing this company as if it's going bankrupt tomorrow.
The analysts are pricing it as if it's the next big biotech buyout.
And when you have that kind of extreme gap,
The analysis concludes that the snapback rally, if and when the financial problem gets solved, can be violent. It's like a coiled spring.
held down by fear.
Exactly. And when that fear is lifted by a capital event, the price could rapidly correct to match the asset's real value.
But hold on. Here's where it gets really interesting. If the science works, if analysts see this massive potential, why is the stock at 28 cents? The market isn't stewed. There has to be a reason.
There is. And it's a terrifying one for investors. It's not clinical risk anymore, it's financial risk.
The cash burn.
The cash burn. That is the one and only reason cited in the report. Biotech development, even after phase 3, costs a ton of money. Reviva needs capital for regulatory filings, for pre-commercial activities, just to keep the lights on until a deal gets done.
And that cash burn leads directly to the market being, as the report says, terrified of dilution.
Let's make that really clear. The company is low on cash. They almost certainly need to raise more money,
And to do that, they issue new shares.
which dilutes the ownership of every single existing shareholder. Your slice of the pie gets smaller.
And at these low prices, that dilution is just devastating.
Think about it. If Reviva needs, say, $50 million, if their stock was at $10, they'd issue 5 million new shares. Manageable.
But at 28 cents.
To raise that same 50 million, they would have to issue nearly 180 million new shares.
180 million. That's
So
more than the current number of shares outstanding.
it would completely overwhelm the existing share structure. That's the fear. The fear of this massive catastrophic dilution is what's pinning the stock down at $32 million, despite the proven drug.
That makes total sense. The game is no longer about the science. It's purely about capital. The report also pointed to a technical aspect here.
It did. From a technical analysis standpoint, the stock is just sitting at these historical lows. It keeps bouncing off a floor between 25 and 28 cents.
What does that suggest?
It suggests that there are buyers at this level, people who understand the asset value and are willing to take that dilution gamble. But the wider market is too scared to let it run until that fear is gone.
So, given all that risk, what's the actual strategy the report proposes for trying to trade this disconnect?
It's very specific and highly speculative. That current low price, the 25 to 28 cent range, is what the analysis calls the accumulation zone.
An accumulation zone.
But the report is very clear. You are not supposed to marry this stock forever. The goal is simply to trade the massive disconnect between price and value when and if a key catalyst arrives.
So there's a binary bet. Either the company gets a lifeline, a favorable deal, or it doesn't, and they're forced into that horrible dilution.
It's all about timing. The thesis is 100% dependent on a capital event triggering the reversal.
And the analysis identifies two of these specific events. It calls them, boom, rocket events.
Right. The first and biggest one would be announcing a partnership.
That would be the ultimate fire extinguisher for the cash burn problem, wouldn't it?
Oh, absolutely. If a big pharma company partners with them, they'd likely get a big upfront cash payment plus future milestone payments.
The dilution fear just
Yeah.
vanishes.
It's gone overnight. The balance sheet is stable, and it validates the high analyst targets. It tells the market that a major player thinks Brilaroxazine is worth a lot more than $32 million.
Okay, so that's catalyst number one. What's the second, boom, rocket event?
Announcing positive FDA meeting notes.
How does a regulatory note cause such a big reaction?
Because it de-risks the final step. Positive notes mean the FDA is on board with the submission. The path to approval is clear. There are no surprise roadblocks.
So it makes them a cleaner acquisition target.
Much cleaner. It could accelerate a buyout timeline and force the stock price to start moving toward those analyst targets much more quickly.
So if we connect this to the bigger picture, the whole strategy really hinges on one of these capital events happening before the company runs out of time and cash.
That's the gamble. The analysis calls it a lottery ticket with real science behind it.
High risk, high reward.
A very high-risk scenario, absolutely. You're betting that they can secure a partnership before they're forced into that catastrophic, heavily dilutive financing. It's a race against the clock.
And that really perfectly summarizes this whole deep dive, doesn't it?
It's the whole story.
You have a company that the analysis paints as beaten down, bruised, terrified by this financial overhang.
But inside that beaten-down company is a scientifically validated asset, Brilaroxazine, that could potentially justify these explosive 2,000% returns.
So you now understand this profound disconnect. You know the science is positive. Phase 3 data is in the bag, good side effect profile.
And you understand the financial dilemma, the massive analyst targets on one side and the paralyzing risk of cash burn and dilution on the other.
It's a massive dichotomy. A company priced for bankruptcy, who its tiny $32 million market cap.
Versus a company that analysts value for a multi-billion-dollar buyout because of what it owns.
Which leaves us with a final thought for you to mull over.
Considering that multi-billion-dollar market for schizophrenia treatment, how much does Big Pharma typically pay to acquire a competitor, specifically to avoid the risk and cost of late-stage clinical trials?
The risk that Reviva has already successfully taken.
Exactly. They pay hundreds of millions, sometimes billions, to buy that certainty. And the difference between Reviva getting that kind of deal